I'm Michael Grossman. I'm managing director and responsible for private credit at New Island Capital Management. New Island Capital is a single-family office, or more precisely, an investment advisor to a single-family office based in San Francisco, California. We invest on a for-profit basis, entirely consistent with the values of our sole shareholder. We invest across asset classes. We have a real assets team, which invests in farms and forests and real estate, principally in the United States. In farms, we're what we call a value chain investor. We invested in organic agricultural production and now processing and sales across several different value chains. Forestry, we're large-scale investors with high conservation expectations and long-term investment horizon. We buy forests. We sell things like carbon and conservation easements. And we are, important to note, direct investors across what we do. We have a private equity team. You know, private equity, as I'm sure people here know a lot better than I do, private equity in mission-aligned investing is really hard to do because, frankly, as a portfolio company, a recipient of capital, you don't really know if the people you're working with mean what they're saying until it's too late, right? When it comes right down to it, everyone says the right things. Everyone says we're never going to ask you to sacrifice mission for margin. But then the day comes when you're being forced to, and it's too late. So actually being a mission-driven private equity investor, it's hard to compete. So I understand that my colleagues who do private equity have a much, much harder job than I do. And I do credit. And teammate in the back, Jessica, and I, and a couple of colleagues based in San Francisco, we lend money to social enterprises, platforms, funds, financial intermediaries. We're pretty much structure agnostic. We lend money to teams that are having a significant social or environmental impact and who can use our capital to both grow what they do and amplify the impact they're having, but more importantly, transition from a source of capital like us, which is artisanal and like really high touch, to more institutional, robust, and a financial services provider rather than a capital provider. You know, I looked at the questions Assad sent over, and I'm a little bit abashed following some of the speakers we had because, number one, they're super articulate. I'm a practitioner. I do these things. I express some of the fundamental beliefs that I have in terms of impact investing through transacting. So I don't necessarily have a lot of the words for it. I was listening to Bruce and Dana, and a lot of things like really struck me in some of the way people said things. And I'm going to talk a little bit about my experience in impact investing quickly. On this slide, wherever it is, it says 1998, year you started impact investing. I was thinking about that while I was walking over here this morning, and actually it was 1985. Very first job I had, I worked for a company that's now called Novartis, was in those days called Ciba-Geigy. And they were negotiating with a series of governments in the Caribbean to meet those countries' health objectives. And they did this extremely complicated, foreign exchange transaction. In those days were fixed foreign exchange regimes, so it was different. So extremely complicated foreign exchange transaction in exchange for some cheap drugs to achieve some social impact objectives of certain governments in the Caribbean. How to use business to achieve social ends. That, to me, is impact investing. First time in 1985. I went to Citibank in Africa after that. In Citibank in Africa, we didn't call it impact investing. Again, we called it business, right? We figured out, I mean, we were doing lending, right? And, you know, figured out a way to finance the Hajj, right? So tens of thousands of West Africans go to Mecca every year. But again, there's a foreign exchange transaction that they have to undertake, and a foreign exchange transaction they have to finance, in particular if they want to lock in the expense of doing this, like paying their rent in Mecca for a week. Right? You think not significant, we start multiplying by tens of thousands of people who don't have necessarily the cash up front to do it and take a risk at the end. Okay? There's a financing solution to that. So we're using a financing tool to achieve a social outcome. We did things like warehouse receipt financing to allow smallholder farmers to access global supply chains. Those days, we just called it trade finance. It's business, right? This is what you do. And that, I think, is one of the most important things as we think about impact investing, is that a lot today people describe it as an asset class. It's not. It's a style of investing. It's a way of doing business. It's a way of looking at all of the stakeholders through a chain and making sure that the allocation of returns reflects the value in each of the stakeholders and the impact you're trying to have. At the end of the day, I work for a rich person. She's great. I mean, I absolutely am lucky as could be to have this tremendous opportunity to invest 100% of her wealth consistent with her values. But, you know, we were having a conversation this morning. I was having a conversation this morning with somebody, and they sent me a note saying, hey, would you like to reinvest the interest that you generated? And I was like, okay, sure, but I want actually a little bit more money on the return that we're going to get. And it like works out to be $1,000 over the course of the next 18 months. And I think, okay, $1,000 to my shareholder, sure, I like the points on the scoreboard. I like the rigor of forcing ourselves to do this in a way that achieves both the financial returns and the social impact outcomes that we're trying to achieve. But at the end of the day, isn't that $1,000 so much more important to the people who are achieving some kind of low-income outcome? Like that $1,000 could pay to send someone to a conference. That $1,000 could pay for an accountant for 2 weeks versus, I don't know what my shareholder spends $1,000 on, but I'm guessing it's not something material. So understanding that trade-off, and I'm not saying we're sacrificing returns, but it is a reminder that business exists, or that capital exists to serve business and not the other way around, and that returns need to be fairly allocated across different kinds of actors. You start thinking, okay, what does that mean? And especially when you start thinking about actors. And someone said a little bit earlier, and the expression I would use is wolves in sheep's clothing. You see a lot of people in the impact investing world who have the greenest creds you can believe. I mean, there's a company that I don't want to say its name because it's a public space, but the guy should own his. But some people here consume their products. Green as could be. Green as could be. You talk to the owner of this company, they are super committed to environmental sustainability and deep rejection of things like GMOs. But the guy's a scumbag. He would happily steal your money in service of his mission. That's not, to me, an impact investment. That's not someone we should be working with. He's achieving an environmental outcome, but in the wrong way, in a non-sustainable way, in a way that his partners and the community in which he works, excuse my language, in that doesn't work. That's not sustainable. So like identifying those companies and how they do what they do is just as important as identifying what they do from where I sit. That's all I got to say. I'm happy to answer any questions. Perfect. Thank you.
I have a question.
Oh, damn.
So when you say that, it's not really an asset class, but, sorry.
Yeah.
But it's an approach, or, can you elaborate on that a little bit in terms of?
Yeah, I mean, so if you think about, like, I was thinking about this earlier. So, like, value investing, right? There used to be something called value investing where you'd find undervalued assets and invest them and the market would move up. I mean, now I don't think there are any undervalued assets anymore. But so there was that thing. And that was a style of investing. And you could invest in real estate. You could invest in private equity. You could invest in public equity. You could invest in any asset with a values approach, or value-based approach. This to me is the same idea, but you can invest in any asset classes. We do credit. I have colleagues who do real estate. I have colleagues who do equities. We have public instruments. But it's the way you invest and the recognition that it's not a winner-take-all game, that it's not zero-sum between us and our counterparts, but that we're actually partners, that the capital we're using and the capital we're generating and the returns we're generating are fair. We should be equitably paid. People are happy to pay extra money for ethical sourced coffee. They should be happy to pay extra money for ethically sourced finance. However, it's only the fair amount. I should not be getting paid more than I deserve because of the impact the people who are using my money are having. you hear this expression a lot on stage in different kinds of events like this, the concept of humility. Let's be humble. Let's be humble before the face of the challenge that the challenge that we're faced with. Frequently, I think that humility is wrongly placed. I think where humility needs to be placed is the recognition that we provide capital. That's it. That's all we do. Other people do the hard work. Now, it's not saying easy to provide capital, but we're providing a utility to other people to do things. Those are the people like Ned in the back, who we'll hear from later, those are people who do the hard work, right? So that's, to me, the approach question.
Could you speak a little bit about the workout side of the business, if you don't mind? So, I think we've heard about the possibility of finding investments that are, because of the nature of the business, if you give them capital and they do more of what they do, there's impact to that. But if the investment doesn't work out...
Very timely question. I'm on my way to Brazil on tomorrow to deal with a workout. And I mean, one of the things I think about, and it's a great question. One of the things I think about is one of the great advantages of working for an organization like the one I work for, which is not everybody, right? I mean, different organizations have different requirements, is that you hear this expression a lot, patient capital, patient capital, patient capital. I think a lot of times when people say patient capital, what they're trying to imply is duration, long-term capital. When I think of patient capital, and I think of it very much as part of the key to this impact investing question, is you don't have to act until you have to act. Like, I could go on Monday and say, guys, pay me back and whatever it takes, and the outcome for everybody, including the impact outcome, is less than optimal. Perhaps being patient, perhaps waiting, perhaps working with my counterparty and understanding what other outcomes are, we can preserve both the impact outcome and part of the financial outcome. So, I mean, to me, it's very much part of what we do, and frankly, losing money is part of investing or lending money. So it's going to happen, and you're going to have losers, and it's okay because we're doing what we're doing for the right reason. So I would rather do what I'm doing for the right reason and lose money than do what I'm doing for the wrong reason and lose money. Because it's going to happen, right? Anyone who says it's not is not really an investor. Sure.
I missed the first couple of minutes, so I'm sorry if you addressed this.
Not at all.
I'm sure you'll have an expletive for me if I did. Yeah. How do you evaluate the potential impact going into an investment to determine whether it meets your criteria? And then at all, if you do this, how do you measure it after the fact?
So great joy of working for a single family office is we can tell stories we don't have to measure. And frequently the measurement is such that we try to work in an area. So there's two levels of impact that are important to us. The on-the-ground impact, so there we speak of something called convergence. So the more money you make, the more impact you should be having, right? You sell more solar lights, you reduce more carbon emissions, you make more money, right? I mean, ideally. So that should be fairly obvious. And that is, again, a little bit dependent on what the instrument we're investing in, right? So if I'm lending somebody money for a short period of time, then my expectations of the impact that's going to happen in that period of time are lower than perhaps if I'm owning a piece of property for 50 years, and that what I would calculate it differently. The other impact we seek to have, particularly on the credit side of the business, is a financial market impact, a transitional impact, trying to bring more robust and institutional sources of capital into areas that are environmentally or socially positive. So for me, we spend a lot of time thinking of the likelihood of what happens after us in the financial market side of things. Right? That's the tool we're using in capital. That's all we do, and we expect that the real impact is going to be you stop borrowing from us and you get a securitization. You stop borrowing from us and you get money from Goldman Sachs or MetLife or a more serious and more serious financial partner. And that's really, we just kind of think about it up front. There's really no, but we spend a lot of time thinking about that. Please.
So I was talking to him, so I missed the very beginning as well. So my question is, just to take it back, so you're working for a single-family office.
Yeah.
What motivated them to start looking at impact, and what was that process like? Because we know from Heron that it's actually, there's some ambivalence there. It's complex.
Different, I think, than perhaps Heron or others. Our sole shareholder inherited a fortune. From where I sit now, I would say later as opposed to late in life, later in life. And she, being a mature person upon the inheritance, basically had a double realization. Realization number one was that she had done nothing to deserve this money except for be born. So she couldn't just simply live a hedonistic lifestyle with it. I think more importantly, and this is going back to 2006, so a while ago, more importantly, she realized that it didn't belong to her, that this money was made by preceding generations and belonged to future generations. So she needed to steward it with the same care that her grandparents who made the money did. So she couldn't just give it away either. So this conundrum right there, she came up with, why don't I create an impact? Why don't I create an investment company that will invest my capital consistent with my values? And it took a while to get it right. I mean, we were created in 2000, not that we've gotten it right now, but created in 2006, I mean, I would say probably cumulatively lost money through 2013, 14. No longer the case as we've kind of figured out what to do, but it took a while to understand, like, how do you actually invest we used to say institutional scale amount of money, and it's not institutional when I see what institutions have, but a big amount of money. How do you invest that and achieve what we're trying to achieve? It's hard.
Hi there, Courtney from Morgan Stanley. I was curious your role. I don't know if this is exactly how you're structured, but the conversation we were having earlier around first-time fund managers and the point that you were talking about bringing in institutional capital and scaling the broader flows. I mean, is that a piece of the puzzle for you? Do you think that the family office that you work with or others should be playing more of a dedicated role to scaling
So
first-time fund managers?
we're direct investors, but I do observe that the impact industry, the social finance industry, I mean, however you want to call it, is comprised of really, really well-meaning sources of capital that are highly fragmented. So if you imagine you're a company and you want to borrow $30 million to grow your solar financing business in emerging markets, and you're confronted with 8 or 9 different family offices, all who can do $2 or $3 million each, none of whom have necessarily the skills to do the financial intermediation, understand what that means to lend money to a company that's selling solar lamps in Africa and India. So what we generally try to do is syndicate other family offices into our deals. And we do it on an informal basis, and we generally do it for free because we believe that this is something that's important for the industry, both important for the industry because it's hard a lot of times for younger people to hear, but financial services is an apprenticeship business. You learn by doing. It's the only way to learn. So bring people in so they can learn how to do transactions, or at least learn how we do transactions. And 2, lower the cost of business for our partners because they don't have to retail out $2 million, $2 million, $2 million. They can go to one person for 20, and then we deal with the back. So we think it's important for the sectoral development, and so we do that a lot. So, we don't invest in funds. We understand the rationale of saying let's find ways to invest in first-time managers because that's intermediation, and I say it up there, lack of financial intermediation is, to me, the absolute failure of our market right now. But that's just not what we do.
Hi, Mary Rose Bruzewitz. I'm a lawyer that works on a lot of transactions.
I know who you are, Mary Rose.
Yep. And I think one of the things that you've touched on 2 things that are very interesting. One is that we always used to say in microfinancing, if we're successful, we don't have a job anymore because Citibank or whoever will lend money, and it's about financial inclusion. And I'm not sure that people necessarily, they sort of hang on to their situations at all levels in the value chain, I think. And I don't know how you feel about that. And then the other thing is this financial intermediation and aggregation. There's a lack of somebody to organize the capital in these little small amounts. Okay, it's a big amount for me. $1 million I would be very happy with $1 million. It's a lot of money, but so I don't mean to denigrate that. But I think, how could we, and we could talk about this later, how could we increase the role of people who can do that? Because, as you know, in a syndicated financing, if you're a borrower, a famous borrower, you say, okay, you can be the agent, but you have to keep some skin in the game. You have to keep X million dollars. And we don't have that role in this market. I don't know if you have ideas.
It's
about
interesting.
that.
I mean, yeah, we spend a lot of time talking about this at work and with colleagues. As the financial markets in the United States and in Europe, I guess, particularly have developed and digitized, that concept of what used to be investment banking or merchant banking has gone away. And so the skill set isn't necessarily there, and the reflex isn't necessarily there, and the customer concept of paying someone to do that work isn't necessarily there. And I tell you what, sitting in an investment committee at our family office, when we see deals that are brokered deals, so this came from a broker, an investment banker, we think, oh, there's something wrong with it, because otherwise they would have been able to raise capital themselves. So there's a reflex that's wrong, and I don't know why. It's a great question, but it's, yeah. People aren't paying for it for some reason yet.
Thanks, Mike.
Thank you, Hassan.
Okay, good early afternoon. Thanks to Columbia and MetLife and SEMA, Assad, Bruce, Matt, for organizing this. I'm sorry that I got here a little late this morning because it's really a different format and seems like it's been a really open discussion. So happy to be here. I am an investment specialist at DWS. We used to be called Deutsche Asset Management. We did a partial IPO about 18 months ago, and still majority owned by the bank, but called DWS, which loosely translated is German fund manager. We have been in the impact investing space since 1997, when we launched our first microfinance fund. We are now on our sixth financial inclusion fund. If we included some of the third-party family foundation type microfinance funds that we manage, this would be number 10. So we've been doing this for a long time. We are now also collectively pulled together our capabilities in renewable energy. So we have renewable energy funds, also clean tech environment. We are doing Africa agricultural finance. And we have also other kind of social enterprise investments, a social enterprise fund that we put together a few years ago. So we're across multiple sectors. We're putting together impact strategies in private debt and private equity. In the last year and a half, we've also developed a new capability, which we're pretty excited about, which is working with corporates to help them address their sustainability goals. So whether that be on climate change and putting together renewable energy investment solutions for them, we're looking at some of the sectors that I mentioned earlier. The team itself is 30 investment professionals. We're located across 4 major cities, New York, London, Frankfurt, and Hong Kong. We also have investment professionals in the field in Africa. The slide up here, and it's just listening and having a better sense. I originally thought the event was up at the Columbia MBA program. I'm substituting for one of my colleagues, so I quickly have a sense. So I think we can probably hit this slide in 1 minute. This is a slide that many have seen that Bridges Ventures put together to help frame ESG and impact investing, and we've kind of manipulated it a little bit to reflect what we're doing at the firm. On the far left is the traditional, purely focused on financial return investments, and then going over towards the right is philanthropy, and where are we? We're in that impact thematic, which is the dead center. When we were first starting in this space, we did quite a bit on the impact first, but now we're solidly into the impact thematic area. Running through the key information points that were posed to us, we've invested over $1 billion in the impact investment funds that we've put together. We talked about the sectors. Returns to date, really can't discuss those on public forum, but happy to talk to those of you who are accredited investors kind of privately about some of this. I think it is fair enough, though, for me to say that since the vast majority, or the funds, which are the private debt, over that 22-year history have really ranged between 2% and close to 8%. So it really depends on the sector, the structure of the fund, the time that we developed it, what were kind of market rate returns, and also the underlying assets. We've done subordinated debt, financial inclusion funds, so clearly those would have a higher return. In terms of advice for future impact investors, everybody who has been attending a few of these conferences the last few years have heard the general, kind of slogan is, get on with it. Don't hesitate. There's a lot. I know we're struggling, and I heard a few of the echoes earlier of there's not enough product out there for institutional investors. Yeah, it is a challenge, but there's a lot of, I think, innovative funds. There's the challenge of doing first-time funds, but there's a lot more product out there than I think people are aware of. If we look at the ESG spectrum, I'm not really talking about like the public equities strategies. There's a lot going on in that space. In fact, I think it's going to bring the institutional investors hopefully closer to that far right side in the next 3 years. Other than climate strategies, it's still been a bit slow to get, mainstream institutional investors' attention on things like microfinance in developing countries. It's that two-step dance. You say Africa or kind of, developing countries in general, people perceive high risk before you can get to the second part of your story, which is actually these microfinance assets are lowly correlated to mainstream markets. They're a good diversification for your portfolio, and we've got over 20-year history of microfinance funds out there that, the vast majority have lost less than 1%. So, and that's, looking at the overall assets, right? So, it really is a compelling story. In fact, in many of these impact sectors, we had to start these funds with multiple capital tiers and often had 20 to 30% risk cushion underneath the senior investors. Well, when the losses now for over 20 years have been less than 1%, it's time that we get rid of that subordination. It's really not appropriate. I think it frankly holds the industry back on some of these structures, and we really need to become more effective in how we explain the risks and rewards of the underlying assets so we can get away from that and really preserve that type of capital for some of the newer areas in the impact industry that really still need that. So let's see, where did I leave off here? So yeah, the advice is, don't hesitate for those of you who have not done it yet. There are products out there. Challenges, which I think were echoed earlier, fund strategies, often aren't large enough when you're talking about mainstream institutional investors. We have a private equity environment and clean tech strategy in Asia, which is quite interesting and compelling. We've had many institutional investors interested in it, but it's targeting a 300 million PE strategy. Some of these investors don't invest for less than $50 million, can't be more than 10% of the fund. Right there, we're disqualified at the get-go. So, we do run into those type of, logistics, I would call them, or mechanics at times. The element of the first-time funds, I really like the way Christopher kind of frame that. That is constantly, especially when you're dealing with OCIOs or consulting firms, right? First-time funds, we don't do it. We don't recommend that. Well, yeah, that's probably a very conservative, prudent approach, but again, these assets been out there for 20 years. It's good to hear a bit of the flexibility, the one that was mentioned by Church Pension Fund with Assad, who had led, many other funds beforehand. So it's not technically a first-time fund. But, you have to, again, have that luxury sometimes of the extra bandwidth and time to kind of explain and connect the dots for folks. So kudos to those who allow that space for impact fund managers to kind of explain, well, we do actually have a lot of history on this. Sometimes the ratings or, risk capital allocation can become issues. Many of the institutional investors don't want to do developing country or emerging market risk. I mean, I would like to kind of flip that and say, look at the GDP growth in most of the countries where we're investing is double the GDP growth in most of the economies where, the asset owners are. Okay, well, let's look at this. Let's kind of, again, go to that second layer and decide which countries we can invest in, or look at the fund and the diversification. We won't invest more than 15% in one country. So let's look at kind of the underlying risk on this, and not just kind of the optics at the kind of surface level. And I think that's basically the majority of the kind of quick information points I wanted to get out there. Maybe in terms of where we are today, we have 3 impact strategies that heavily overlap with the SDGs. And again, to reinforce, we're doing private equity and private debt. So one of these is the Clean Tech and Environment Fund in Asia. Private equity has higher returns, as it should have. Another one is a blended finance transaction doing Africa Clean Energy Access, and it's a strategy that we have the support of an anchor investor, the UN-affiliated Green Climate Fund. And so that's, echoing or overlapping with some of the discussions earlier. That's 2-tiered capital. We have subordinated, more patient investors who would be in there for a commitment of 15 years. And we have, senior investors who would be in there for 7 years, decide whether or not they would want to renew during that period. So again, trying to put together structures that match perceived risk or actual risk, but getting to the root of some of the issues that we're trying to address as the impact investment thesis, which is Africa is the continent that has the least access to electricity. Let's try to leapfrog and make sure that when that electricity comes on board and we help bring it on board, that is done in a kind of green approach. So and then our third is we have a global microfinance strategy with an emphasis on gender equality. And so given the fact that we've been doing global microfinance the longest, and it's an industry that has the longest track record, we feel compelled that we should be bringing some additionality to that social delivery. So on our last fund and this fund, we're including additional overlap. So gender is really the focus on this next fund, and we're excited about it. So I think that's kind of the messages I wanted to share, and look forward to answering any questions you might have. Yeah. Hi.
Louise, you had mentioned blended finance, and could you go into that a little bit more and how that works in terms of getting public sector and private sector actors to be on the same page and follow the same strategies and try to harmonize some of the requirements? Particularly in sectors that are perhaps less, where there are higher risks, and just kind of maybe some of your background doing that would be helpful for people here to understand a bit more about how you can harmonize the investment approach in a blended finance vehicle.
Okay, yeah, thanks, Michael. So blended finance is one of the terms that we've put perhaps on something that other people would know as kind of multiple tiered capital funds. So in general, and this is kind of nomenclature we use a lot in the development finance field. Blended finance is when you're blending different types of capital essentially to achieve what your investment thesis is. So in many of the early impact funds we did, we often had 3 or 4 layers of capital to help crowd in all those investors. So this theme that we're talking about of how do you aggregate investors that might have different risk reward requirements. Okay, a blended finance transaction is how you do that. Okay, normally you have at least 2 different types of capital in that. Often and technically, blended finance also refers to funds that could have a technical assistance component to it. So for example, many of the early microfinance equity funds would have a roughly 10% compartment in technical assistance grants that they would use to help those microfinance institutions basically build up and become more professional and develop, stronger finance functions, credit functions, MIS systems, et cetera. So blended finance collectively is referring to either bringing in different capital at 2 or more type layers, or a structure that also is crowding in some type of grants that can be used to help underlying investees or other theses of that impact fund. We, up to the current fund for microfinance, had a blended finance approach. We had, different investors. The first institutional investor fund that we put together in microfinance was back in 2005, and that required, having junior capital to get many of the private mainstream institutional investors into that fund. The one that we have currently available in Europe and soon, hopefully, in North America, doesn't have any subordinate capital. Why? Again, we have 20 years in this industry of impact funds and microfinance. We have that track record collectively, and we think it's time now to really kind of try to put together structures that are kind of more professional, mainstream, that may not require that at this time based on the underlying risk metrics there. The blended finance is still incredibly important, as Michael was referencing, in terms of new areas that we're opening up in the impact field. So, Africa, clean energy is a prime case. That still takes a bit of explanation, education, and there's still risk there that warrants having junior capital in there for development organizations or highly motivated, impact first type investors. That is a very appealing, subordinate position to take, because they can help crowd in the private investors that would, otherwise hear Africa and say, no way, we don't do investments in Africa. Okay, so it gives them the breathing space to say, well, that's a 30% or 25% risk cushion. It's, actually invested prudently in terms of credit policies and diversification amongst those countries. And yes, my institution and my board is emphasizing climate change and also the SDGs. This is actually a really interesting strategy. So it can help kind of bring that all together.
Because you had asked, we introduce oneself. So my name is Cyril Arnould, an old friend of Assad, as I mentioned before. I have a career with EBRD, IFC, now EIB. In the last 10 years, I've been leading a blended finance investment platform for renewable in frontier markets. And I would say, I'm trying to answer your question. Half of our capital is from public investors who are junior, and the rest is from private investors, quite a few from the US. The investment strategy is exactly the same. I mean, blended finance, the project recipient doesn't see the difference. This is blended. Really, where it comes in is how risk is managed, and you do it through the distribution of the return. And to me, we launched our fund in 2008. It was years and years ago. Really, what it helped do this risk cushion is bridge to put it kindly, the lack of knowledge, but the ignorance of many investors about frontier markets, because lack of knowledge means risk. I mean, nobody should invest, in something you don't know or don't understand, and it's kind of a catch-22. So in a way, what we have done is infected knowledge in many private investors, because now they have been receiving through our quarterly reports and our distributions of their capital back, what it is. The second thing is something which is rarely mentioned, and we have found, especially with institutional investors, pension funds, insurance companies, etc., is their own supervisory or prudential systems prevents them from doing, certain kind of, many of the investments that fall under the impact or ESG, system. To put it very bluntly, for a pension fund or an insurance company, it's easier to invest in a coal-fired plant, because there are 60 years plus of data to plot how this is going to behave than into a solar farm, which everybody knows has very low tech risk, etc. And I'll just leave it there because I could speak for too long. If you look at renewable in developing countries, those are markets where the prevailing price of electricity is very high, and the supply does not match, the demand by a huge margin. This is a perfect, investment opportunity. It still baffles me that, very smart, cohorts of MBAs still need to, a lot of explanation and data to understand that. Today it's like saying investing in Africa is like people investing in China 30 years ago were seen to be idiots. They just look at 2 or 3 fundamentals and say, even if I'm wrong by 50%, I'm still in the money. Africa is exactly the same. I'm not saying, you need to learn how to do it. You cannot, be a proficient investor. I mean, it was just said earlier by, I think, Christopher. Yeah, it's practice. You just practice it and you get it, try to get it more often right than wrong. I don't think that was a question.
But thank you for the commentary.